Okay, as Trish said, my name is Graham Niven. I'm an accountant by trade, so I qualified a long, long time ago. When accountancy firms had proper names, like names of people, it was Pete Marwick, Mitchell when I joined. Whereas it's now it's KPMG and PwC, they're all letters. And I qualified and I left. As soon as I qualified, I left, went into industry. And I was an accountant in industry, and then I was a financial controller, finance director, got out of finance, did loads of other things. And for the last probably about 10 years, I've been running my own business. I have worked for some other people in the meantime, but generally I run my own business. And I'm actually a funding specialist, so my main role is finding funding for businesses these days. So I do 10 grand to 10 million. Most of what I do is about 50 grand to 500,000, maybe that sort of level. But I would do a £10 million deal if I got one. It's just, you've got to find the right people and you've got to find the right source of money. So that's what I do most of the time. But I also go into companies and I talk to them about their finances and about what their finances mean, making sure they've got the right information so that they can run their business properly. I'm a big cash person. Cash is everything. So, but I don't want to preempt anything, so we'll come to that in a minute. Understanding finance. We're going to talk about some words. We're going to talk about profit and loss, we're going to talk about cash flow, and we're going to talk about balance sheet. These are all things that accountants talk about left, right and centre every day of the week. And the words, the reason I put words up is because I was conscious what sort of words do you hear every day, and I don't know, maybe you do know what they're about. So things like gross margin, assets and liabilities, but then you'll see some maybe that you're not so familiar with. So things like EBITDA, which isn't a word, it's an acronym. Depreciation, everyone talks, loads of people talk about depreciation and what is depreciation, what isn't depreciation, accruals, double entry bookkeeping. Double entry bookkeeping is the most wonderful thing you've ever seen. I can see you smiling in your face, but it's just perfect, double entry bookkeeping. So hopefully there'll be some words up there that you do recognise. Hopefully you may have some other words that you think that I wish you'd talk about those. Hopefully they will come up. If they don't come up, please mention them. But I'm going to then now talk you through each of these three things that I mentioned before, which is profit and loss, cash flow, and balance sheet. Those are the three main accounting reports, methodology, if you like, in terms of how to run your business. So, profit and loss account. I'm going to do very much a mixture of on here and on this whiteboard. Sales versus turnover. I was asked this not an hour ago about what's the difference between sales and turnover. Does anyone know if there's a difference, or what is the difference if there is one? When I'm sat down there and people ask me questions like this, if there's someone speaking, I hate it because no one really wants to put their hand up. But if you do know the difference, and to be honest, we'll start now. There is no difference. Sales is turnover. It's just a different word for the same thing. But does anyone know if you're reporting whether you should report sales with VAT or without VAT? Is anyone here running the gentleman?
You are reporting without VAT.
Without VAT. Absolutely. Because, and forgive me, I'm going to start here straight away. If I say I charge my services out at £100 an hour, and I say to Trish, right, you can have an hour of my time, and it's going to cost you £100, and I'm VAT registered, which we'll come to in a minute, then there are two rates of VAT at the minute, 20% and 0%. There is also something called exempt services. There are certain things that you have that are either exempt VAT, and it is relevant, but my services, were I to charge this rate, then that would be 20%. So I would charge, and Trish would pay me £120 for an hour's worth of my time. Okay? But my sales would only be £100 because this isn't mine, unfortunately. This belongs to the government, which is a shame. But nevertheless, that's what it is. So when you're reporting turnover always has to be, and I use turnover more than sales, turnover always has to be without VAT because you're just misleading yourself if you count your turnover. And people do. I have loads of clients. I have a number of clients who say, "Oh, I've done so much sales," but they always say that, and they say, "Oh, well, then when you take the VAT off, then it's 20% less." So it's a sort of misnomer. You do not have to charge VAT if your sales in a year, in a 12-month period, are under, at the minute, 85 grand. So If you go on to HMRC's website, you'll see all the rules about VAT and about when to charge VAT and when not to. There isn't, and when I say you have to charge VAT if you're over 85,000, you do. But if your sales are below 85,000, that still means you can still charge VAT, but you just don't have to. Legally, you don't have to. The benefit of charging VAT is that you are then able to recover VAT on purchases that you buy that yourself have VAT. So I'll just do a really quick thing about that. So this is my sales of £100 and £20 VAT. And say I buy a chair. A chair cost me 50 quid, but that is a vatable supply. So 20% of that is £10. So I actually pay £60 for the chair. So when it comes to my VAT account, I owe the government 20 quid and I can recover. That's called output tax. This is called input tax. I can recover the £10. So the only thing I pay to the government, I pay the net, or you pay the net to the government of £10. Normally people account for it quarterly, so you collect VAT for a quarter and then you pay the difference over, and you suffer VAT on a quarterly basis. But you can have flat rate schemes, and there's loads of different flat rate schemes depending on what trade you're in. If you go on the HMRC website, there's a really good explanation of it. And I think for like what I do, I think it's about 14%, but you charge 20 and then you incur VAT on certain things, but you could potentially benefit from it. But you just pay over a standard, say 14%, or 12% or whatever that figure is. When I sell, so say I sell to Trish in January, that's 100 plus 20, that's 20 quid. That's effectively when the sale takes place. But Trish, she's a nightmare. Doesn't pay me for months. You know, she's really a bit short of cash. So she doesn't pay me till May. She says, I'm short, Graham, I'm buying a new house, haven't got any money. So she doesn't pay me till May. But the problem, she doesn't pay me 100, she pays me 120 quid, which obviously includes the VAT. But I've got to pay that, say that's my quarter, I'd have to pay that over in April, so I'm out of money. So there is a thing you can do, cash accounting for VAT, where you only actually pay the VAT over when you receive the money. And that tends to be where you have a lot of circumstances like this. Again, I'm not a VAT expert, but if you go on the HMRC website and look at VAT, and it lists down all these sort of things that make you think about.
What's it called again?
This one's called cash accounting. Cash accounting for VAT. I think it's called a cash accounting scheme. There's a turnover limit of about 125 grand. It's not about 125 grand. I'm pretty sure it is 125,000. So if you sell £1 million a year, you can't do cash accounting. But I'm pretty sure if it's under 125 grand, you can apply for it. And I think there are certain criteria you have to meet. If I'm honest, I don't know it all. It doesn't. I've never done it because I don't have this long gap type thing between invoice. It's mainly for businesses that can have a significant difference between when they invoice the item and when they get paid.
I have one of those businesses.
You have one of those businesses. Well, have a look at that. Have a look at HMRC Web. I'd say it's really good. It's not the most exciting website in the world, but nevertheless, have a look at that because it may just help your cash flow, because normally what's happened to you, having to pay cash back to the revenue that you haven't got. And you will get it eventually, but it's a problem. What else was I put on it? When is a sale not a sale? Is a deposit a sale? Yeah. I suppose it depends what each of your businesses do and what sort of, how you invoice things. So things like technical development, software development, etc. Do you charge, so say to develop the new software is, 35 grand. It depends how from a cash flow point of view, you don't want to spend effectively, let's just say it costs you 20 grand to do this. That's all your programmers or whatever it is. So you're going to make £15,000 profit on this. Should have done profit and loss first, shouldn't I? Anyway, we'll come back to that. But that could take 6 months, presumably. So would you want to charge in both a deposit or in according to key criteria, key milestones, etc. And because there are certain, from a cash flow point of view, you want to charge on a regular type basis. I imagine you don't want to wait till the end of the 35 grand before you get paid. If I was buying off you, I'd say, well, I'm not paying you that amount of money. You've not delivered me anything yet. You only delivered parts of it. So it's a negotiation sort of thing. But from a pure sales point of view, from the VAT point of view, VAT is you're liable to charge VAT when you provide the service, at the earlier point of providing the service or receiving the cash. So if they send you a deposit of, I don't know, 10 grand, you should account for that. So say that's January, you should account for that then in that period. So the question of when is a sale not a sale is really down to how you charge people. You invoice them up front or no, at the end? During. Right, okay. We're similar. I mean, that's what I do. I charge like that. But there are a lot of people that have bigger projects that have to charge on a regular basis. I don't know if anybody works in construction, but you have applications for payment. If you're building a building, you get a thing called application for payment, and you get a QS to come in and say, well, you've laid 20,000 bricks and that's X pounds per square metre or whatever it is. You never go into construction. It's one of the worst things in terms of being paid by contractors you can ever come across. They're properly good at delaying payment. But nevertheless, that's how that works. And so you do get this ongoing thing. But then, and I've got a client at the minute, they have billed, can I tell you the name? Yeah, AstraZeneca. They've billed AstraZeneca a lot of money for a particular thing that they've done for them. And it's round about 1.5 million, it's about 2 million quid. But they've got, on this particular job, a 5% retention, which is a retention based on that this thing that they've done works. It doesn't just work today, it works next week, and it's a 2-year retention. So it's £100,000 they're owed on this particular job. But they've not billed it yet, because if they bill it today, well, first of all, the client won't pay it. And secondly, the VAT will become due on that particular thing, which is 20 grand. So they have not billed that £100,000. They will bill that at the end of the 2-year period when this project has been commissioned and has been working for a certain length of time. So the question of when is a sale is a sale. They talk about this as a £2 million project, but £100,000 of it hasn't been billed yet. So, and people tend to do it, yeah, this is an interesting thing. People tend to do it for VAT reasons, but they also do it for tax reasons. Does anyone know how a profit and loss account works? If not, this is going to be a really quick, right. A very simple profit and loss account has turnover, which is the sales, and we'll say £100,000. I'm going to go through a typical profit and loss. Cost of sales, we'll say, is £40,000. And this is what's called gross margin or gross profit. And just, you'll see gross profit percent, gross margin percentage. This is what's called overheads. And these are all the other costs associated with, I'll come back to each of these in turn. Let's just say that's 30,000. And this is net profit. Okay. And generally, I will come back to each of these, but generally you are taxed on your profit at the end of the year. If you're a limited company, is it most people here limited companies or, yeah, okay. As a limited company, you get corporation tax. Corporation as in a limited company tax. And that's currently 19%. There are various differences depending on how much your profit is, but let's just say it's 19%. Unfortunately, I don't know what 19% of 30,000 is. It's so much easier, it's about 6 grand. It's not much, it's around about 6 grand. So that's a typical profit and loss account. Right. Turnover, I think we've talked about. We know what goes into turnover. Cost of sales, and people talk a lot about this. Sometimes it depends whether you have a product, i.e. baked beans. Sorry, Trish, but I'm on a baked bean roll today. Baked beans. So baked beans, so you sell, let's just say we sell 10,000 boxes of baked beans at £10 a box equals 100,000. Those baked beans only cost you £4 a box to make. So that's there, and therefore your gross margin is £60,000, or your gross margin percentage is 60%. Why is that relevant? So what tends to go into here are the costs directly associated with making those baked beans. Okay, so it's the baked beans, the raw, I don't know what, haricot beans, whatever baked beans are, baked beans, tomato sauce, the heat in order to heat up the bake the baked beans and heat up the sauce, the cans, the packaging that you put them into, and probably the distribution of those to wherever they're going to, Tesco, say. There are arguably a number of different sorts of costs, which I will come to. Direct costs, which are the ones which are said. There are then variable costs, but you can have variable costs in here, and then you've got fixed costs. So, we've talked really about the direct costs of sales, those that go in there, beans, the people to pour the beans, etc., unload the beans, etc. So in a manufacturing organisation, that tends to be production people.
So that's the staff and them.
That's the
staff.
Yeah, the staff who are making them. But Doris in the office, who does the accounts, she doesn't care whether you've got to pay Doris whether she makes 20 baked beans or no baked beans. Well, yeah. So she is typically a fixed cost because you pay her week in, week out. I mean, obviously, if you never made any baked beans, you wouldn't have her in the role. But nevertheless, as a general thing, she, regardless of whether you make 1,000,000 baked beans or 1,000 baked beans, she's a fixed cost. Variable costs tend to be things that move according to the amount of beans that you make, but not always directly related. So, I've got a list of costs that I was going to ask you. Now, did I write them down or did I put them on here, in which case I can't do that because then you'd cheat. No, you wouldn't. Right, let's just think. So rent, fixed or variable or direct? Fixed, absolutely fixed. This building, fixed cost. There's nothing you can do about it. Whether we are here or no one's here, there is a rent on here. Marketing. Yeah, and it's an interesting, I mean, people talk about marketing. You can turn it off. You can just turn off marketing and say, I'm not doing any marketing. But most, there's a thing about semi-variable costs or a mixture of costs. I'd say marketing, generally, people have an underlying level of marketing. UK Fast is a classic example of an organisation that spends a lot of money on marketing. And they've probably got a baseline of marketing, and then it goes a bit like that, doesn't it? A bit up and down when they're launching, I don't know, when they're doing their run or they're doing all the stuff that they do. But it's almost like there's a fixed element and then there's a variable element. The reason it's important is because you've got these costs regardless. So if you didn't sell any baked beans, turnover zero, no cost of sales, that's fine because you've not sold anything. Gross margin though would be so. Let me just show you on here. So we didn't sell any bit. Although let's say we sell. Oh, I can't remember how many I did there. Did I do 10,000 at 10? So we'll do 1,000 at 10. So we only sell 10,000 pounds of baked beans. Cost of sales the same percentage, so 4,000, and therefore we make 6,000 at gross margin level there. Okay, still margin. But we've got fixed costs, fixed overheads like rent rates, power, telephone, insurance is a classic fixed cost, yeah. And then you've got variable costs. So let's just say this split was 20-10. Let's just say we can turn off all the variable costs, turn off marketing, turn off training. Training's a classic variable cost. But whenever businesses are struggling, the first thing they always chop is training because they can. Because they just say, well, stop doing it. Not saying it's always the right thing to do, but they do. So our fixed costs here are 20 grand. So we're minus 14,000 in that particular month. And that's all because you've got You know, this fixed cost element of here isn't going to go away. So, what's the point of all that? The point of all that is it's great to get this as high as you can, as long as you're going to be making a margin here. You have to create a profit by what you sell, be that a service, a product or a service. And then if you can strictly control your overheads, then you should make money. I mean, that's what it's all about. That's what we all do. That's what I do. Hopefully that's what you guys do. And the reason I actually started doing this particular thing, this net profit, is I said that your corporation tax is based on that. And because I'm a bit obsessive, that's 5,700 quid corporation tax, 19% of 30,000. Consignment stock is where you send stock out, and then you put stock into a particular place, and then they draw it off, and every time they draw it off, it's a sale. But you've delivered them, say you've delivered them 10,000. It's a bad example. 10,000 packs of baked beans, and they draw them off, and then you invoice them every time they draw it off. It's called consignment stock. But if it's not relevant, then we won't do it. So let's just say you do 3 hours, 36 hours for the year. You have 36 hours. You can draw them off whenever you want. And because it might be you do a lot of them at the beginning of the year, and then it eases off towards the end of the year. I suppose there's a difference between a contract and invoicing and the provision of that service. If they're saying, I will pay you 36 hours times £100 an hour, 3,600 quid for the year for what you do for me, you've got some options. You could bill them in advance, but then you've got the VAT to pay, and they might not pay you straight away. You could bill them monthly, an equal amount, so 360 quid a month, for what you do. Or you could bill them when they take the service. From an accounting perspective, there's nothing wrong with either of those, but there is a cash implication for you, particularly if it's VATable. Then you would have to pay the VAT on the upfront amount, even if they haven't paid you, unless you're doing cash accounting, which you have to be less than £125,000. So, and if it's spanned a year end, then again, you might want to think from a tax perspective, a corporation tax perspective, do I want to be paying tax? So if your year end is at 30 September, and let's just try and make it bigger, £12,000 is the overall bill, and they've drawn down 6,000, you don't really want to be invoicing for the other 6,000 here, because if you do it here, A, you don't have to pay the VAT on it straight away, and also you'd be paying corporation tax on £12,000 worth of income. Well, I know there's but effectively you'd be upping your profit by £6,000 potentially, and you might not want to do that. The good thing about accounting is you can justify it certain ways depending on what it is you want to do. So there are tax reasons. Another reason you might want to charge it is if you're trying to raise some money. I mean, I get involved in raising money for businesses, so I want profits to be as high as possible because it's easier to raise money for businesses when they're showing good profits. And you say, oh, but I've moved £6,000 in. These guys have committed. I've got another £6,000 of turnover. I say that was £60,000. I've got another £60,000 of turnover. I could have booked it, but I didn't. Then I, with the funders I'm talking to, I've got to say, well, he could have billed another 60,000. It's much easier to show it in the books, but then if they don't pay you, sorry to keep moving around, Trish. But if they don't pay you, then you've got a £60,000 debtor, which we will be talking about, just sat there in your books doing nothing, and it doesn't look very good because it could be there for another 6 months. So the good thing about accounting is you can vary it depending on what you want to do. I get a lot of people who I'm raising money for have adjusted their accounts to show minimal profits for tax purposes, corporation tax purposes, but then want to show maximum profits for raising funding purposes. And they're in this dilemma. So they've thought, oh, I don't want to pay much tax, I'll reduce my profits as much as I can, which legally, I mean, this isn't dodgy or anything, but then they say, oh, I need to raise some money, and then you show the funders their accounts, and they're not very good because they've not made much money. And they say, yeah, but underlying that, it's really good profits. And you say, well, yeah, but it's not hard. It's hard to show. I mentioned impact of exchange rate only because I think I had turnover at 100k. I had, that's turnover, cost of sales. So you'll sorry about this, but these are all accounting things. You know, turnover's T-strike-O. Cost of sales is cost of sales. GM is gross margin. Cost of sales. So we said 10,000 times £10, but then we said 10,000. I think we said times £4 gives you 40k, and that's right. That made 60k. But if you're buying your baked beans from America, and the cost and the exchange rate goes badly the wrong way, and these now cost £5, then you've just taken £10,000 out your margin, and it's your margin that pays for all your other overheads. So I don't know whether I appreciate this is not a production-based group, but you do have to think about things like that, about changes in the cost of the goods that you sell, or the cost of the services. So it could be that you employ programmers to do work for you, and that's a direct cost of producing the service that you've got. Therefore, and if the market's tight, which I understand it is, and getting good programmers is tight, then you have to watch. I say this a lot to people. You have to watch your margin. You have to make sure that you're making money at this level. And there's two ways that you don't. One is you don't sell enough, well, three ways probably. One is you don't sell enough. Two is you're not able to charge as much as you'd like. So say competition comes in, and using your cleaning analogy, I imagine there's a lot of competition in that market, and people will try and undercut you to win business and do it at £9 an hour. You can do it at £9 an hour, and et cetera, et cetera. So you've got to be careful. And therefore, do you take your prices down to £9 an hour to match, or do you say no, that's what it is? And I don't know. And then you get what's it called, the wage thing? Minimum wage.
Yeah, and living wage.
Living wage, yeah. So that has pressure on this line on cost of sales. So this is where it all goes on. Below the line, all the overheads and things are quite interesting. And I'm not saying you don't have to focus on them, but most of the businesses I've helped, where I've helped them increase profitability, it's all been up here. It's been less down here. It's not to say that and I'll talk about overheads in a minute. It's not to say you can't do it down here, but I'm very much sales, and if you sell, the more you sell, the more money you will make, generally, as long as your costs up there don't run out of control. That's my experience. So you just got to make sure that you're making a good enough margin up here, and you need to protect that margin by being better, cheaper. I just said cheaper, didn't I? Better, high quality. I don't know. Depends what you do. You're a management consultant, so you charge a set rate. There are other management consultants out there, presumably some charging more, some charging less, but you charge a rate for the service that you do, don't you? And I don't know how competitive it is in your field, and whether price is an issue, or whether it's. With what I do, I try and steer away from price and get it down to the quality of what I do. And because it's high, as soon as you get into price, then there's always somebody somewhere that will undercut you. Always. I sort of did this. So the fixed overheads that I talked about, things like rent, rates, heat, light, power, people costs. Generally, people are a fixed cost. The people who work for you are a fixed cost. I know you can get rid of them, and I know you can sack them and make them redundant, etc. But to a certain extent, they're a fixed cost. Insurance, accountancy, you've got to have your accounts done. I appreciate you can do your own. Variable overheads, things like agency labour, you can turn them on, you can turn them off. Various legal costs sometimes can be. Marketing, we talked about. Printing and stationery varies a little bit. I wouldn't say it's a completely variable cost. Training, I said, is one of those costs that people tend to, as soon as money's tight, they tend to turn off training. Some that I said that are mixed, things like travel expenses. You can't really, I don't know, again, I'm not always looking at you, but I know what your business is. You've got a cleaning company, you can't just turn off your travel expenses, but maybe if business was a bit less, you'd do less traveling expenses. Maintenance, again, it depends whether you've got equipment that needs maintaining, or instead of having this thing serviced annually, quarterly, do I get it serviced every half year? Telephone is a bit of a mixture one. I think telephone's one of those ones that there's an element that's fixed and there's an element that's variable. And there's an argument that the less you sell, the more time you spend on the phone trying to generate sales, as opposed to the fact the more. But then having said that, if you've got people ordering stuff, then you may be on the phone more. It depends whether we're talking mobiles or landlines or fixed contracts or variable contracts. One thing I did put on here is a thing called step costs. And it is quite relevant. I said that this is a graph of, this is pounds, this is time. So time going that way. So if we've got turnover going up like that, that's turnover rising. What I said is that these are fixed costs, and fixed costs by very definition. This could be rent. I'm still renting the same building as long as I don't quadruple into, well, like UK Fast had this building and now they've got that building. But that's fixed costs. And variable costs, we'll say, they go up along with sales, but maybe not quite as high. But one thing you do get, which is, sorry, that's variable costs there, that's that line. But one thing you do get is something called step costs. So you go along, and then suddenly at this point, you need to invest in the business. You need to do something. So, I don't know, in terms of cleaning, whether you have vans and people going out, but then you get that much work, great, all your marketing's work, you have to increase, you have to buy another van, you have to run another van, you have to run 2 or 3 more people, etc. And then your costs go up like that, and then you have to go, that goes along. That goes along that way for a while, and then it goes like this, and it goes like this. Costs that are step costs tend to be either when you're taking on people or when you're investing in equipment, be that vehicles, manufacturing equipment, etc., that sort of thing. So step costs, so you've got ones that are fixed, completely fixed, you've got ones that could be step costs, things like people, equipment, and then you've got variable costs, the sort of things we've got on there. We had turnover 100, cost of sales 40, gross margin 60, overheads 30, net profit 30. Okay, and we said that at 19%, that came to 5,700. Corporation, that's corporation tax. That's tax on company profits. There will be adjustments, tax adjustments. This is not a tax seminar, but I'm just saying generally that's round about what it is. So this tends to be what's called net profit before tax, but on there you'll see net profit before tax and interest. So if you have borrowed money to run your business, bank loan or well, any sort of loan, you potentially will have a £6,000 interest charge. So your profit down here is 24,000, and therefore, so it's a deduction. But it's all the way your business is financed you tend to work out the net profit here, and then you say interest, and then it's profit after interest. Why is that? The reason is often so you can compare different businesses that are funded by debt mainly, bank loans, etc., and businesses that are funded by equity, so investment. Where does everyone know the difference between? And I'm not going to ask that. There is a difference between debt and equity. Okay, we'll go to that. We'll do it over here. So debt is where you borrow a sum of money. We'll say 50k, and there is interest on top. Let's say that's 10k. It's over 5 years, and ultimately you will pay back £60,000. So that's the total debt, £60,000. And so basically each month so that's the debt, 50, and that's time. And over a 5-year period you will pay it back, and it'll go down over time. Okay, that's what debt is. So you could borrow £50,000 from the bank in order to set up your business, or in order to run your business, to expand your business. Or you could do equity. Equity is a different thing. Equity is a share of your business where you sell a share of your business. And so very much if you watch Dragon's Den, you'll see people come on and say, I want, I don't know, 100 grand or 50 grand, and I'm going to sell 20% of my business. And they say, no chance, I want 30% or 40% or whatever the figure is. So you could find it by equity, so 50,000. But there's no interest on equity. You know, it's not well, you can get interest on equity, but generally it isn't. What you get in equity is normally what's called a dividend. And a dividend is a share of these profits. It's a profit share. Okay? So the main difference between equity and debt is that you have to pay this. You have to pay this. If you're in a contract with a bank and you say, I'm borrowing 50 grand and I'm paying you, I don't know, £1,000 a month for the next, it would be £1,000 a month for the next 5 years, you pay them £1,000 a month for the next 5 years. Otherwise, the security which you probably have to give on this, which is either a personal guarantee or security against a house or security against the assets of your business, they'll come for those. So the debt you have to pay each month. A dividend, if you don't make any money, you cannot pay a dividend. So whoever invested in your business hoping to get a dividend out of it, I'm sorry, you haven't got it. I'm not saying it's a bad thing or a good thing. It's just a way of funding your business. But on equity, there would be no interest. There would be, if you didn't have any debt, if you'd put 50 grand in yourself at your own savings or something, say, or you'd got your Uncle John, whatever, to invest £50,000 in your business, he would be expecting a dividend out of the profit. So the profits would be here at this level, and he would get, say you got 50% of your business, and say you were going to distribute all the profits as a dividend. Not the best idea, but let's just say you were. He'd get 15 grand. He's happy, whatever. You'd still pay corporation tax on that. So it's very rare to give all your profits away as dividends because you generally can't afford it because you haven't got enough cash.
So you still have to pay it on that 30?
Yes, yeah. So the reason for saying all this is that there is a thing called EBITDA, an acronym called EBITDA. And I'm not saying it's relevant for you now, but it might be relevant at some point. And EBITDA stands for earnings before interest, tax, depreciation, and amortization. So, we've got loads of new words there, haven't we? We're going to cover depreciation and amortization in a little while. And all it is, to be honest, is a measure of profitability that is comparable across different companies. It's hard to assess company A against company B sometimes, company C, company D. But if this measure takes out, particularly this bit here, interest, because if your company is funded by your uncle and your company is funded by a bank loan, it's hard to compare them like for like. So if you do it before any interest charge, they're more easily comparable. Similarly, your tax situation could be different. You could have made losses in the past and you're bringing forward what are called taxable losses, and so your tax is less, whereas you maybe have always made a profit. Well, the whole tax situation changes the way you could assess your company. So you do it before then. You could buy loads of capital equipment, in which case you've got depreciation. You might not buy any capital equipment. So it's a way of taking out some variables so you can assess businesses. Now, it's quite hard, to be honest. You'd have to be running very, very similar businesses. But for the really big companies, like your Tesco's and Sainsbury's, you would assess them on the same level. So you take out depreciation, tax, amortization, and interest. So people who invest in companies can compare them better. If you're selling your company at some point, let's hope everyone in here makes a fantastic company and it's worth a lot of money. Typically, a company is sold on the basis of EBITDA time. It's not quite this simple, but bear with me. One of the measures is EBITDA times a multiple. So you take the profit, an adjusted profit, and you times it by a multiple, and that multiple could range from 2 times this is called earnings, 2 times earnings to, in the real sort of dot-com boom in the 2000s, you would get them 78 times earnings. I mean, just ridiculous valuations, just complete rubbish. Typically these days, 2 times to maybe 10 times earnings. So if your profit was 100k and then you would multiply it by this factor, and that would be the value of your business. It's not quite that simple. I'm trying to make it quite simple, but that's one element of value in a business. The real question is, how do you get that? What's that multiple? Because obviously, if it's 6 times, it's worth 600 grand. If it's 2 times, it's worth 200 grand, and that's where the figure come from. I knew someone was going to ask that. Right, it varies, but one of the things I do is, I think I said is, I can't remember if I did, I sell businesses as well. And we're selling a business that is making £1 million profit, and we're trying to sell it for 5 times that, plus what's called the free cash. And the free cash, what that means is the money, the actual cash they've got left in the bank after everything else, and we're expecting that to be 2 million. So the total for this is going to be about 7 million. That's what we're marketing this business as. That's what we're trying to sell it for. Right, so the question is, why 5 times? Where does that, because to be fair, the £1 million is an accounting thing. That's, as you've seen already, that's completely accurate. There's no chance of that being varied in any way, shape or form. The cash, we're pretty sure we know what we're going to have cash-wise. So the real trick here is to get this as high as we can. Now, what's it based on? It is to an element based on the turnover. The higher the turnover of the business, generally the greater the multiple. That figure there is called the multiple. It's based on the history of the business. So if this is 2018, and in 2017 they lost $500,000 and they lost 0.9 million here, whatever, then the chances are we're not going to get 5 times, because or it worse actually if it's like this all the time. That's the worst sort of profit type thing to have. The history, the team. Are the guys who are selling this business, are they staying? Are they staying for a while? Are they staying forever? They want to just get some money out of the business? Or, let's be frank, are they going away and trying to set it up again? Which obviously you wouldn't be allowed to do, but nevertheless, you'd make sure that wasn't the case. The market that they're in, the sector. So for instance, something like restaurants. Restaurants are a nightmare. Hard to fund, hard to sell. It's just so many restaurants fail, so you get less of a multiple in that market. Whereas if you're in a market where you've got a particular niche, where they need your product and you are the leader in that product, you'll get more for it. So that's the higher multiple. So this multiple here is based on loads of different things. There isn't one thing. And I have no idea why we came up with 5. We just made it up, and we haven't sold it yet. So the purchasers may be saying, well, no, we want 4 times or 3 times. And we say, but we'll say, but look at the turnover history, look at the history we've got. This company has made consistent profit. You've got a great team. 2 of the team are staying full-time, 2 of the team are going to stay part-time. The market sector that they're in is quite niche. There is competition, but they're viewed as being one of the leaders in this particular market. So that's why we've come with 5 times. But the turnover, it's only 5 million. Sorry, the turnover £5 million, and they make £1 million profit. The turnover's not huge. So for that reason, if it been £10 million turnover, we've probably gone for 6 times. But as it isn't, we're only going for 5 times. And we hope in this particular case that we're going to sell this business to a company that exports or that has international possibilities. This particular company that I'm talking about only sells in the UK. The only export they do is to Ireland. That's what they consider export. They don't sell abroad, and the product is international. It could be sold anywhere, and they just say, "Can't be bothered. It's just too hard work. We don't want to do it." That's honestly. I mean, that's what they do, and so we're looking for an international company to buy this, who have links abroad, who then we can sell their product abroad, and to be honest, who also have products that we can sell into this company's clients. That's what we're trying to do. So we think it's a really good fit for a particular company, which is again why it's quite a healthy multiple at 5 times.